thank you everyone for joining us this evening. So I'm Gaurav Narayan. I've been managing the India Capital Growth Fund for almost a decade now, and I'm based out of Mumbai in India. So before we begin, if I just request you to briefly read through the regulatory disclosure. So for those who are not very familiar about Ocean Dial and the India Capital Growth Fund, just a brief overview. We are India specialists. That is, we invest only in the Indian equity markets. What differentiates us is that we invest in the mid and small cap segment of the market. And this is a market segment we find there are a lot more opportunities. I think it's a very good, well-managed companies. But also it really feeds into our investment trust structure because we can actually take large positions in relatively less liquid names as well. So how I really want to structure this presentation is I'll speak for about 25 odd minutes and split it into three parts. First is really the structural story that is playing out in India. The second is really as a fund, how are we trying to take advantage of this opportunity? And the third section, I'll really talk a bit about the risks people see in India, especially these days on the valuations, given that the Indian market has done fairly well. So to really start, I thought I'll just give an overview of India, and it's best to compare it with the UK market because in terms of GDP, we are almost at the same size. I'd like to really point out three key factors about India. And the first is the demographics. What you see in the slide here, India has 600 million people under the age of 25. What that actually means is that you're getting about 1 million people into the workforce almost every month. So that's the sort of opportunity that there is in India, but it's also the biggest challenge that the country faces because you've got to provide jobs to all these people. The second is on the growth, and it's fairly evident here that India is a much faster growing economy. And the third is another very interesting fact that if you take the leverage of the economy, both at the corporate sector and at the government level, it's not very high. It's not really a leveraged economy. More so in the household sector where it's you've really not even touched leverage levels at the housing level. So really, what is the story of India? And I would really say the key story of India is that it is turning out to be a very fast and high growth market. And what I've shown in this chart here is the IMF growth forecast. These are the latest growth forecasts. And what it really shows is that India is the fastest growing large economy in the world today. The key point I'd like to highlight is that India is today growing at a much faster pace than China as well. And my own belief is that this is not a 1 or 2 year phenomena. Rather, we'll see this 6 to 7% growth play out for several years to come. So why am I so confident and positive of this growth being more structural than a short-term phenomena? And to really take you back a bit, it's largely to the fact that the economy is coming out from a very aggressive reforms phase. And today the environment has changed fairly dramatically over what it was even 5 years back. So what the country has gone through is since 2014, when the Modi government came into place, you had reforms virtually across sector, ranging from the real estate sector, the entire banking sector, even the entire taxation system was overhauled. What it did was it led to a lot of inefficient businesses collapse. You had a banking crisis, you had a lot of consolidation in the market. But broadly, there was so much uncertainty that it actually led to growth faltering. But that has actually changed substantially. And if you see this chart, the slide on the left, this is the non-performing assets in the banking system. What you see is from 2014 to 2018, it really peaked at about 6% for the gross non-performing assets. But today, you have a situation when the banks are sitting on the best ever asset quality, a very high level of provisioning, very well capitalized, and ready to lend. A similar story played out in the corporate sector, and that's the slide on the right, which is the corporate profits to GDP. And this also took a absolutely dramatic turn for the worse, simply because businesses collapsed. Most companies started focusing on their balance sheet, and the result was there was a lot of deleveraging which was happening. But today you're again in a scenario where the inflection point has been reached, and corporates also now have low leverage and also in a position to invest. But the change really has happened after this, that now the government has taken the call that they really now need the economy to grow. And so the entire focus of the government is on growth, and they're doing this through two means. The first is on infrastructure. And today, India has a pipeline of almost $1.8 trillion of infrastructure projects which are being implemented or in the process of being implemented over the next 5 years. Now, this pipeline is about 9,000 projects, of which almost 2,000 plus are already under implementation. And over 50% of this is actually being funded by the government at the central and state levels. Now, to give you a perspective of how it is, like I'm sitting in Mumbai in India, and today Mumbai is, if you come here, it's a bit like a construction zone. There are like 9 metro lines being built simultaneously. There's a bullet train project which is under implementation. There's a new greenfield airport coming up in Mumbai. There are 2 greenfield expressways being built, one going all the way to Delhi, which is almost 1,600 kilometers. There's a coastal road being built across the length of the city. Together, I would say that over $50 billion worth of infrastructure projects are happening in the Bombay city alone at the moment. And it's really not just Bombay. You'll find 27 cities in India where metros are being constructed. Delhi is also getting a new greenfield airport. So a lot happening on the infrastructure side, and that's what's really kickstarted the growth. And the second aspect of the growth is the private sector itself. And here again, a bit of credit to the government that they've started providing a lot of incentives to the private sector. In fact, they selected 15 sectors where they felt India was a very large market or have had strategic strengths, and they've provided almost $35 billion worth of incentives to companies, which could actually lead to an output of almost 450 to $500 billion over the next 5-6 years. And this is just not on paper. It's actually happening on the ground today. Most of these capacities are already being put in place. And again, to give you a current example of what's happening, you may be reading a lot about the problems Apple is having with its sourcing from China, largely due to the COVID restrictions. But what you possibly don't know is that over the last two years, thanks to this scheme, all the 3 suppliers of Apple have already set up base in India. All the models of the iPhones are being manufactured in India, including the latest launched iPhone 14. In fact, Apple has already started exporting out of India, and I believe over the last 4-5 months, they've exported over $1 billion worth of iPhones already. So that's really what's happening, and it's across semiconductors where three projects are coming up in place, and a whole host of sectors where you're seeing that. So what we're actually seeing is today, if you look at a lot of high frequency indicators in India, most are pointing to a fairly healthy economic and vibrant economy. And to give you a few examples, this is just showing the credit growth in the system. Today, the credit growth is trending at over 16%. And this is at almost a 9-year high. And this growth is not just retail, it's actually across. It's retail, it's large corporates, it's mid and small corporates. If you speak with banks within the corporate sector, it's working capital and new capex happening. So there's a lot of momentum which really is getting reflected in the credit growth itself. A second very interesting indicator of how things are shaping up is this chart, which is actually the monthly collections of indirect taxes. And the box on the right is showing the average monthly collections over the last 12 months. And the box on the left is showing the average monthly collections pre-COVID. Your indirect taxes today are trending on an average 40% higher than pre-COVID levels. That's again showing signs of the sort of pickup in the momentum we've seen. But having said that, sitting in the Western world, I think one of the biggest concerns everyone has is how is India really coping with what's happening in the global environment? And to that, I would frankly say India has actually shown a lot of resilience. And I'd like to put it through two aspects of why we feel India has reached some form of an inflection point here as well. This is a chart showing the currency, the INR versus the US dollar over the last 25 odd years. What we've seen historically is whenever there's a global crisis or any global event, the currency is the first to depreciate. And one of the reasons is that we're still dependent, 85% of our oil is imported. So any problem and the currency collapses. And in each of the crises we've seen, be it the Asian crisis in the late 90s, the global finance crisis, the taper tantrums, the currency invariably in that short period of time fell by almost 20 to 30%. In the current environment, it's been remarkably resilient. In fact, the currency, though, has depreciated about 11%. But if you see compared, it's actually appreciated against a lot of the developed market currencies. Now, there is a reason behind it. In fact, there are many reasons why this has happened. But one of the factors is that as an economy itself, we are no longer as stressed on a balance of payments. And one factor here is what I've shown in this chart below. This is the flow of long-term capital into India. This is foreign direct investments coming into the economy. This is really through PE funds investing in infrastructure, investing in large capex projects, investing in the digital economy. What till 2015 on an average used to see inflows of about $35 to $40 billion. This has structurally changed, and you're actually seeing capital of almost $75 to $80 billion per annum over the last 3-4 years. And the government's own projections are this is actually going to move up even further. But what it's done is it's led to India really accumulating a lot of forex reserves. And today, India is sitting on the 5th largest forex reserves in the world. And if you compare it with UK, where actually our forex reserves are almost 3 times more than that of the UK economy. So that's what it's done is it's provided a lot of flexibility to the central bank to be able to manage the volatility in the currency. And that's, I would say, a big change we've seen in India, that the currency is no longer very volatile. It's not collapsing on any news flow. The second aspect is on inflation. And here I've compared inflation in India versus the US and UK. The dark blue line is the inflation in India. I think 2 things I'd like to highlight. One is a very rare environment where inflation in India is trending below that of the developed world. But the second and more important is if you see the trend line in India on inflation, India has historically, today the inflation in India is about 7%. But historically, if you see India's inflation has pre-2015 always been in the 8 to 9%. It's only after that it came down to 4% levels. But the crux point is that at 7%, Indians are really not feeling the impact of inflation. It's not a talking point of discussions everywhere you go. And it's really not impacted demand at all, simply because people have been used to high inflation. Salary increments typically have been 8 to 10%. So it's really not impacted the economy in any meaningful way. So, uh, while this is a positive side on what we see on the economy from a structural point, let's go a bit more onto the micro side and how are we trying to play this opportunity through our portfolio. I would say, our mid cap focus it really feeds into our portfolio, and we're very well positioned given the sort of opportunities we are seeing. And our trust structure, where you can actually get into some relatively less liquid names, really is ideal for a growth sort of economy. So how do we really invest? Uh, I would say, for us, we are very, very bottom up focused investors. We always look at absolute returns. That is really, we don't look at what is the index, and if a stock is in the index, we should be in our portfolio. In fact, we take very active positions. Almost 90% of our portfolio is an active portfolio. That's one side of it. The second aspect on our investment strategy is that we're always looking at buying businesses which we want to own for the long term. And when I say long term, we're really looking at holding these businesses for 5 years or even more. And the result is our portfolio turnover is very low. It's just about 10 to 12%. But today, over 60% of my portfolio, I'd have held the stocks for over 5 years. That's the real nature of our investment strategy. While investing in a business, we focus on three core areas. The first is management. We are very, very conscious on governance, but we also want business management which are very dynamic. The second is on the business itself, where we want to own businesses which are scalable, predictable, but at the same time, they have to have some niche, which either gives them pricing power or a cost advantage, so that, these are businesses which you really want to own for a long term because of their structural advantages. And the third aspect is on the fundamentals itself, that we are very cash flow focused. If a business does not inherently have the ability to generate free cash, we will not invest in it. We are very conscious on return on capital employed, and we have a fairly high threshold of almost 12% on return on capital employed. So really, what we are really trying to do is buy good businesses which we want to own for a long time. Now, how are we doing it? We have a fairly strong team of 4 analysts, very senior analysts each, almost 15 to 17 years experience. 3 of them are based out of Mumbai with me, and 1 is based out of London. At the same time, we have a very strong governance structure, a very experienced board, and a very independent board to really govern us. So really, coming a bit more to our strategy of how we are building portfolios. So what I've really done is I've bucketed our portfolios into 4 real buckets. The core of the portfolio is the extreme left bucket, which is what we call our consistent compounders. Most of these businesses we've owned for about 8 to 10 years. And to give you an example, take a company called PI Industries. Now, I've owned this for 10 years. This is an agrochemical company which actually makes insecticides and pesticides. But its strength is its R&D. So what it does is it actually partners with global agrochemical companies for their core R&D for new molecule discoveries. And if a product gets commercialized, not only does it become a supplier to the global player, but it has a domestic business where it actually gets the product registered, markets it under its own brand. Now, when I bought this company, it was a few $100 million in market cap. Today, it's about almost $6 billion. But the key is that the business on earnings in this 10 years has compounded on an average of 20% per annum. Now, what's more interesting is it's the outlook, that it's actually moved as it's got scale. It's moved not just into agrochemicals, it's doing similar work for the pharmaceutical industry. It's moved into the chemical engineering industry, where it's in the electronic side of it, it's doing a lot of work. So the market size has expanded. and the growth trajectory has actually not changed. So despite it being for me been me for 10 years, it's still something I really would own for several years to come. Where I'm buying new stock ideas is really in the second bucket, which I'd call the high growth stocks. These are some of the new age businesses playing the themes of the environment, on supply chain shifts happening globally. uh, so, for example, you have a company called Sona BLW. This is a company we bought about a year back, and it's an auto ancillary company, but in making very high precision components. And it's really a play on the electric vehicle segment. It's actually supplying a very complex component called a differential gear assembly to almost 23 electronic vehicle manufacturers across Europe, the US, and even China. Tesla is possibly one of its largest customers. Now, this is a business where you get one platform and you have a predictable business for the next 8 to 10 years on that platform itself. So, very high growth visibility. The EV component of the business was just 4% of their turnover. Last quarter, it was almost 29% of their turnover. It's actually growing in multiples. And the average earnings growth of this company itself is about 50% per annum. So that's the kind of businesses we're really looking at. So really what I'd like to highlight is in the portfolio, what we really try and do is, while we do invest in mid and small cap companies, every company in our portfolio is either a leader in its segment, or it has such USPs that it actually gets its pricing power or a cost structure, which really makes us believe that this is a fundamental long-term story for the portfolio. Uh, what I've done in this slide is I've put it in a slightly different perspective. And what I'd like to highlight is the table at the top. This is really comparing our earnings growth of the portfolio and its valuations versus the market valuations. And what you're actually getting is a much higher earnings growth uh, for the portfolio at a lower valuation than the market. So it's higher growth versus the market and lower valuations versus the market. A second point to note from the table is the earnings growth itself. Earnings for the next 2 years are growing in excess of 30% per annum. I mean, this year I would say there is a bit of a base impact with certain sectors like financials, etc., seeing a very high growth because they're coming out of the COVID phase. But the fact is, historically, we've seen a portfolio which has grown at 18 to 20%. And this higher growth is because we are actually seeing these new opportunities. And more importantly, a lot of things are falling in place in India, which is really giving you so many opportunities. The pie charts at the bottom really show that it's a fairly well diversified portfolio, with financials and consumer being the largest component of the portfolio. And the pie chart on the right is really reflecting the area of the market we play in, which is mid and small cap. We have 9% in large cap, but all the stocks in that section really are stocks which we bought as mid caps or small caps and as over time become large caps. So moving on from the portfolio, I thought I'll address one of the key concerns most investors have. When we talk with investors, I would say the most investors are fairly now comfortable with the India growth story. But I think the two questions they always ask is, the Indian market has done well and it's expensive. So I thought I'll just spend a few slides before I end on how India looks on valuations. So this is a chart of the MSCI India index. This is a price to earnings chart. And what you can clearly see is the market has actually re-rated. India historically used to trade at a PE multiple of 17 to 18 times. And this has almost moved up to 21 times forward multiples. So in contrast to what's happened for the rest of the emerging markets, India has actually moved to a valuation premium. It's actually a lot more stark when you see this chart. The gray line is the performance of the MSCI Emerging Market Index, and the blue is the performance of the MSCI India index. So it's really the gap has widened dramatically, and one of the reasons is that MSCI Emerging Market Index has collapsed largely because of China, which has almost a 30% weight in this index. So really, from both aspects, India appears both absolute and relative. It has moved. It definitely looks expensive. But to answer this question of why have we reached a situation where India is moving in a different direction from what we are seeing in the rest of the emerging markets, and I've plotted this very interesting slide. This is the flow of funds into the equity markets in India. The blue line is the foreign institutional investors flows into India, and the gray line is the money flowing into the domestic equity mutual funds in India. Now, what you've seen in the blue line is actually foreigners have been very aggressive sellers in the Indian market as well. In fact, over the last 12 months, almost $25 billion has moved out of Indian equity markets from the foreign sellers. But the gray line is where the what has changed. And in this same period, the domestic equity mutual funds have seen almost $42 billion flow into the markets. And that's actually reduced. It's really cushioned the fall, or it's actually led to the Indian markets being fairly stable in this period. Now, our belief is this domestic flows is actually quite structural in nature, and it's not a one-off. And the reason behind this is when you go into what's driving these domestic flows, it's actually money coming from retail investors from tier 2 and 3 cities. It's actually small ticket sizes coming in the form of systematic investment plans. And if you go back in time, you'll find that for the last 4 years, every month, the domestic equity mutual funds have seen $1 billion of more of net inflows coming in from this retail investor base. So it's really been 4 years, and despite volatility in the markets, the money has kept flowing in. And why this is happening is that historically Indians largely invested their savings in physical assets, primarily in real estate or gold. And now you're seeing a small bit of it moving into financial assets, and part of that is actually moving into equities. So when we speak with most mutual fund investors, they have most in mutual funds in India. Most are fairly confident that they no longer need to even market the funds. The systematic investment plans will keep flowing into the Indian market. So what it's really doing is it's actually reducing the volatility a lot in the Indian markets and is providing stability to the markets. But having said that, my own belief is if you're really looking at investing in India, you should not look at India from a short-term perspective. And I've plotted this table here, which is showing the returns of the Indian markets versus some other markets over a long period of time. This is 10, 15, and 20 years. So what you'll see is both the mid-cap index and the large cap index have actually delivered almost 13 to 14% compounded returns over this last decade. In fact, it's almost matched that of the US market, which has possibly had the best 30-year run in history. And if you compare it with the UK market, it's on a different level itself. You see our portfolio performance also that, over this last decade, which I've been managing it, we've almost delivered a 14% sterling return over this period. So what I'm really trying to say is that you'll have to look at the long-term growth in India. And if you start getting caught in the short-term one-year valuations, you may always find India very expensive, because the moment you move, because of the growth we are going to see of 6 to 7% real GDP, you will always find that over a period of time, India should ideally do fairly well. So I'll really end with that with one last slide. And this is a slide we really picked up from data from the World Bank, which has actually ranked countries on the GDP over different decades. And the orange line is where India ranking in terms of where it stood on absolute ranking in terms of GDP. And what you'll see is every decade, India has been moving up the ranks. In fact, in the last quarter, India actually overtook the UK in terms of GDP. So we're actually now the fifth largest economy. And going by the World Bank forecast, over this next decade, we'll end up being the third largest economy in the world. So I'll really end off on that, this is a growth story, and you'll have to really look at it from that perspective and leave it to questions. Thank you.
Excellent. Thank you very much, Rob. We've got plenty of questions, as you say. So there's questions about ESG. Now, we know it's a very, very fashionable, it has been a certainly very fashionable investment trend. How is it playing out in India? Because I was wondering if it's almost kind of creating opportunities, because, by some measures, it might not appeal to most ESG friendly investment destination. But yeah, what's your perspective on the interplay between ESG and the Indian market?
Well, I think ESG is becoming very prominent in India as well. And I think companies have really no choice, because what I've seen, especially in our portfolio companies, is all the businesses which were globally focused had no choice, because once you're in the supply chain, you have to meet the standards set by your customers. And many of the companies took the choice that they would try and be the leaders in the industry in that field. So I would say the export-oriented companies were the first to start. But the government has also put in a lot of pressure, because the government has signed a lot of agreements. India said they want to be carbon neutral by 2070 and very aggressive targets. So a lot of laws and regulations have changed. And companies have realized that, it's if you do not adhere to the standards, you will perish. And I'd say a lot of companies have taken the lead in trying to be industry leaders in that sense. And from our side also, we've done a lot of work on ESG because we see ESG. In fact, I have some slides. We see ESG as a business risk, a key business risk. So what we have done is, way back, almost 3 years back, we took it upon ourselves to try and be ahead of the curve in our own investment strategy. So what started off just with a negative list of companies where we weren't comfortable with governance or the environmental standards, we've actually moved on to the next level of actually trying to now rank our entire portfolio companies. And in the process, we've actually been having very detailed discussions with our own corporates and sort of the disclosures which they've given and what they've not given. And we've actually find that across the board, companies are very receptive. The government has made many mandatory disclosures, and we are actually in a position where we are actually being able to rank a lot of our companies. And I would say India's, we do find that it's actually helping our investment decision, because some companies, which are actually small cap companies, we're actually finding are actually global leaders when it comes to the sort of disclosures they made and the sort of ESG practices they've done. So I think in Indian companies are taking it very seriously, and they see it as a serious business risk if they are not ahead of the curve.
And you mentioned, I think one thing that really stood out to me is you mentioned about the impact of oil on the currency. India is a much bigger part of the global economy than it was at the time of the great financial crash. Do you see other ways in that a global economic slowdown might affect the Indian market?
Well, certainly it would. And if you recall, I started with a slide on the IMF growth forecast. And there you've seen a growth of 6.8% by the IMF. This is the latest forecast. But if you go back 6 months, the same forecast were giving India GDP growth of 8.4%. And the entire slowdown you see on the GDP growth from 8.4 to 6.8 is entirely attributed to what's happening in the Western world and the recession being talked about. So India will and is definitely going to get impacted. But having said that, I think the impact will be slightly less than a lot of other emerging markets, because one is, if you see in absolute numbers, we are only about 2.5% share in global trade. And even as an economy, our exports is about 15% of GDP, which is much lower than a lot of, China and other East Asian economies. So there's definitely going to be an impact. And as we keep growing, we'll be more integrated. But some part of the impact, I would say, is getting offset because India is actually gaining a lot out of supply chain shifts. So a lot of exporters out of India are actually seeing what they're seeing on a slowdown on one side. They're getting actually incremental business because it's moving out of China, some part of it into India.
And there's a question here about how your outfit differs from other India-focused funds and trusts. Again, there are a lot more of them than there were maybe 10 years ago. And I wondered if you could tie that into the particular focus you have on small and medium cap companies.
Yeah, I think the big difference is that we've always been focused on the mid and small cap space. And we've always found that there are a lot of opportunities in this space. And as I mentioned earlier also, that most of the companies we buy are actually leaders in the industries. Now you'll find the top 100 companies are very actively covered. Every fund has those companies in their portfolio. But our strength is that we have a team sitting in India on the ground. I've been doing Indian equities for 30 odd years. We spend a lot of time meeting managements, and we're really trying to find the gems coming out. And I would say our investment trust structure suits us very well because we can take weights which on relatively less liquid names, but which are very well managed businesses. So I think the key is getting in with the right management, and that's where the maximum due diligence really happens. Because when you're the first investor in some of these businesses, you have to be very, very careful on the corporate governance side.
Absolutely. And there's been some questions here about the transition to electric vehicles or greater electrification more generally. How well equipped do you see India on that front? And I mean, already, we've got people here asking sort of specific questions about charging points, about, what percentage of the country is actually kind of on the electricity network. So, yeah, how well positioned is the country for that electrification transition?
Well, I think if you ask me, India would be the leader in the two-wheeler electric transmission. And we are already seeing that happen. You have India is the leader in two-wheeler market, and everyone has already set up large facilities. For example, now you even have new age companies setting up, one of them has set up a 2 million vehicle plant already, going up to 10 million vehicles. And you're seeing the big inflection on the two-wheeler side simply because it's easier to charge. On the four-wheeler side, I think we're still a long way off. I think charging infrastructure and the space to park, I think that's still a long way off. I think it's still some time away. The process has started, but I think it's minuscule today in terms of where we are on the four-wheeler side.
Excellent. Well, thank you so much for an informative presentation. So one of the comments that came through was, I really hope I get a recording of this presentation. If that was you, and I know you're probably not the only one thinking that, everyone will be getting a recording. And I think, given the extent of information and data there, that's probably quite, obviously we're grateful you included so much, but I think there'll be a lot of people going back through that and really looking at some of those numbers, because they do seem to be doing the business, so to speak, at the moment. So Gaurav, thank you again so much for joining us.
Thank you so much.
From India to talk us through the trust.
Thank you.